Volatility is very low, I think, because the VIX is not just one product. It's an amalgamation of 500 securities, right? And they're going in different directions. So there's very low correlation is the issue, that some stocks are going up, some stocks are going down, therefore the index goes nowhere, which produces very low index level volatility. So, this is really crushing for macro traders because there's divergences globally. You've got China doing reasonably well, not so much in the equity market, but economically. Europe pretty resilient, the US is sort of sliding a little bit. You've got divergences within sectors. We've been looking at value versus growth, cyclicals versus defensives. There's divergences everywhere. So that's been crushing for the macro traders, the derivative volatility traders. It's been pretty good for stock alpha traders.
There's no such thing in derivatives world as more buyers than sellers. What there is such thing as more initiators who are buyers than sellers, or more. See what I mean? Because you have a set number of contracts or an open interest, which can expand or contract as well. But you've got the same number of buyers as sellers. It's just a question of who initiates that trade and who creates the direction of travel. Do you think, though, when you talk to equity traders or equity customers or brokers and what have you, that they are being very complacent about this level of the VIX and actually that they think it's just going to carry on in this very low trend because we've got July, August around the corner and we know the summer months can be very difficult to trade liquidity-wise. Is there a degree of complacency out there?
There may be, but there are so many different actors within the VIX space in particular. I think what's more likely is that a lot of macro discretionary and also sub-macro, more alpha discretionary type investors already have a view of what's going to happen in the next 6 months. We're expecting a slowdown in the US. They've already got their positions. They're set. They're trying not to change them. At the moment, they're being squeezed out a little bit. Every time the market goes up, the shorts need to be cut. But if you're in a position where you aren't long the market, you don't need much protection. And if you're short the market, your protection is actually to buy the upside, not the downside. So for a while, we've had this environment where macro discretionary or discretionary investors generally have not been particularly active in markets. It means that the quant funds, as a proportion of market activity, have become more important. And so the flows that we're seeing on non-farm payrolls prints and CPI prints and things like that have actually been more consequential for setting the trend. So we've got nowcast data we publish once a month. And ordinarily, it's just interesting, but there's lots of other things going on. But it's become really important now in terms of having a good understanding before the data comes out of what we think the narrative is going to be. And for a while, the narrative has been resilient jobs, resilient demand on retail sales and even industrial production, auto sales, and pretty elevated inflation. It's starting to drift lower, but even our data for June, obviously we've had non-farms already, but we've got CPI and retail sales coming up. Even the data for June suggests resilience, but a grinding slowdown. So this is not, we've all got PTSD about volatility from the crisis or various crises. This is just a grinding slowdown that's going to take a while. We expect the market to go lower, but not in a volatile fashion.
Right.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.